Well, I appreciate the chance to speak with you. Dan O'Brien's my name. I'm an ag economist at KSU. And our focus will be on key grain market trends for this year. And the big issue that just is striking is how, are we kind of echoey? It might just be Dan O'Brien. Okay. We've got tight stocks emerging across the board on these major commodities, and you stand back and look at it, it's apparent graphically. So we've tightened up considerably, and with that tightening, we've gone to higher prices. And our analysis today, what we'll talk about, and try to be to the point without belaboring it. Look at corn, sorghum, wheat, soybeans, and I want to mention cotton. There's probably, unless someone's from down Sumner County in those areas, we do see some cotton in the eastern half of the state. There's that Southern Kansas Cotton Growers Group down there. There's Anthony Gin, and the one is it Wakefield or Winfield? I keep getting that mixed up. Anyway, have gins down there. It's certainly an issue from there to the west also. So throughout the summer, we'd seen great concerns about dryness up in the Dakotas, and that affected the development of crops in that area without question. That drought there had gone up into Canada, to where they have they put out sets of numbers, and analysts come in after each monthly set and say, yes, but this is really where it's going to end up at. It's just that much lower. I think the carryover strength you've got in the wheat market has to do a lot with hard red spring wheat problems up in Canada. And also, we don't pay as much attention to it, but all the white wheat production problems they've had in the Pacific Northwest. That was offset by, here during the summer months, we kept seeing dry conditions, not outright drought, but dry conditions in a good chunk of Iowa, parts of Minnesota, et cetera. You'd see some coming into southern Wisconsin, northern Illinois, but generally really good rainfall, very good corn production, corn, soybean production conditions through this, basically on a line that seemed to start from about Garden City and run up to Toledo, Ohio. Just really good. And we hadn't seen this dryness come in until later. Generally throughout the summer, we had decent moisture in that part of the world, but this is showing up in parts of Kansas now, just right ahead of, normally we'd say right ahead of wheat seeding. It's we were seeding wheat earlier than normal, 1 or 2 weeks earlier than normal, 1 or 2 weeks earlier than Hessian fly-free dates. Even questionably early, and I think that had to do with drought in some of these areas, not a early corn harvest. People are trying to get ahead of it. So real dryness here, generally pretty good conditions throughout the rest of the country, and this now emerging as a challenge. In terms of projections, this was the latest I could get as of yesterday. Still some pretty dry conditions hanging on here through these areas. The latest kind of creeping issue is concerns about disease that's come in on corn production in Illinois and elsewhere. So just one more factor for hand wringers like me to take into account and wonder if the USDA's projections of corn crop are too high. But moisture's come in to some of these areas now in terms of soil moisture, and particularly in parts of South Dakota, still North Dakota's rough, Montana, all the way through there, a lot of moisture in those areas. So in terms of world grain market expectations, I think there's about three big key issues to think on, at least that I'd like to present to you, and I invite you either to agree or disagree, and with vocal vehemence if you so choose. pardon me. First, and the first one is that in light of high prices, that the world intends to respond with strong production, particularly in corn and soybeans. High prices, they see the type of selling prices we have, and their intent is to plant a lot of grain. They see a profit opportunity. By the USDA's numbers, world corn production projected to be up 7%, exports up 12%. And our main export competitors, South America plus Ukraine now, production up 25%, exports projected to be up 36%. Of course, when we say South America, these are crops that haven't been planted yet. They're going to be harvested next year. So it's really subject to whatever weather blessings or maladies could come its way. For soybeans, production projected to be up in the world up about 6%, exports up about 4.5%. South America, our main competitor, production projected to be up 7%, exports up 13%. This big increase had a lot to do with South America having a rough time with its second crop, corn. So it projected strong response. Interesting for wheat, whereas corn and soybeans as major world commodities projected to rebound strongly, wheat's kind of projected sideways. And you keep listening to the weather. You say, well, Russia's got this issue, Ukraine's sort of okay, but then you don't know what's going to happen in Europe, et cetera. So, and we've got dry conditions. We'll see what happens in the next couple of days with rain in the U.S. and dry spring wheat conditions, and in northern U.S. on into Canada. Those soils haven't really recovered yet in terms of moisture. So wheat production projected to be up marginally, and exports up some, exports unchanged. So I guess as a key idea, if we really, when you make projections, you assume everything being normal. You're not looking at a drought. You're not looking at geopolitical unrest, a blockage of trade going between the U.S. and China, or because we're mad at each other over something, or Taiwan getting in play, or supply chain challenges coming in. So, these projections are based on no problems happening. If people are unconstrained, no issues coming into play, we'd have higher corn production, higher soybean production, which when those crops hit, it would make for a lessening of current prices heading into the second half of 2022. About the time when we'd be looking to harvest. And we don't have the U.S. 2022 corn crop in here. This is just South America coming into that. Anticipated U.S. crop acres, crop plantings, fall 2021, spring 2022. Now I'm going to show you numbers that are all positive. And somebody yesterday said, okay, now how can everything be positive? The point is that everything could be justified standing on its own to have more acres, but that'll be the challenge. Winter wheat, we don't know exactly how much you'd have. If winter wheat was at these levels and other crops were low, then we'd probably see a lot more increase in winter wheat. Winter wheat, say up 3 to 5%. We have high crop insurance prices. I think it's $708 as the planning price for RMA crop insurance for the coming year. Soybeans up, tight current supply demand. We're now disappointed at $12.90 to $13 soybeans, which is about $3 or $4 higher than it was the last 2 years. But we remember $15, $16 soybeans this summer. So our frame of reference has been myopically impacted by what we just experienced. But the last 3 years, these are tremendous prices. So in human psychology, whether we're happy or not depends on our frame of reference. The short term, we sure wish we had those summer highs. Corn, also strong, also tight, current supply demand, high prices, also up. Sorghum, likely up. I think the time for sorghum, whether it's going to have a strong year or not, will have to do with once we get crop out of the field, and will the main export buyers, which is dominated by China, will they come and will they buy it? You know, are they going to buy it or not? It's kind of prove it time for soybean, for grain sorghum. And then you've got cotton. Cotton at strong prices now. It's more of a world market issue that's affected us here in the U.S. Probably an issue of moisture in some of those areas that look drier. So this was pointed out to me yesterday by an astute young banker. Said, now wait a minute, how can all those be positive? I thought CRP was going to increase. Well, that was a good question. But each of these standing by themselves would probably see an increase. I think there's another factor that we're not even, that this is masking over, and that's the challenges we're seeing right now in terms of buying inputs for some of these crops. Fertilizer prices, herbicide prices, strong. And at our meeting in Garden City, had one representative that was working with co-ops in that part of the world that helped to handle finance, was talking about how they used to get supplies on into those cooperative systems about every quarter, no real worry, you know, what can we send you? Now she said, this person said, now they check every week. I said, well, is that good or bad? She said, that's bad, because they just have certain limited amount of supplies and they're just hand over fist trying to get hold of it. So that's an issue. And another, one of our extension agents, married to someone who works in one of those for an independent company, and said that this person, that their spouse is getting calls at 4 and 5 o'clock in the morning, just to see, can I get hold of supplies? So what does that mean? Well, it at least opens up, I think it opens up a question as to whether we have all the inputs available to actually fit the production model, to fit the budgets, to fit the inputs that we need to produce all these crops. Which are the biggest input costs on here? Well, corn. You know, corn takes a lot of inputs. I'd contend, from working with cotton budgets, you have to have you're using a lot of growth regulators, herbicides, etc. There are different ways to combine all that, but all of them cost a bunch of money, and they're all chemically based. You know, you have to stop the cotton plant from becoming a tree and convince it that it's a shrub. If it becomes a tree, it gets rank growth and you don't get the cotton out. So they've got to regulate the growth. Costs a lot of money to do that. So, our best laid plans based on having free flow of all the inputs that we want could very likely get complicated this year. Who's the winner in that? Well, sorghum on some acres generally doesn't take quite as many inputs. That's more maybe a central and western Kansas deal. Rich, I've even wondered, you're sitting there, so I'm going to pick on you. Rich, I've wondered about if people see all the problems they're having getting inputs here, do they come in and put more wheat out, you know, early? Because wheat, you know, hot markets are good. Generally, you don't have to have as many inputs. So maybe wheat gains out of this. So I guess with the higher input costs, we've got a input supply issue to look at. I guess I think from an ag lender's point of view, I think the person people to go talk with right now would be your fertilizer dealers in your town, in your region, to go find out what they're really dealing with and how much their costs have gone up. Because I think that can boomerang back around on you and affect what your lines of credit for production costs will be for some of these folks. It's a tight supply for a lot of this stuff, for fertilizer, for herbicides, and just if they can get hold of it, it's going to be pretty expensive. So I'm not joking in that I think I'd go talk with those people and just have a finger on the pulse of what we can actually get locally in terms of crop supplies this year. So I've got, I'm not going to show all the all the slides that you've got in there, but I just want to hit on some, and some that just show here, I'll even move over pretty quick. But let's hit on corn and sorghum first. So for corn, the big issue, what we're really looking at would be tight stocks and prices that of 5.45 projected by the U.S. as a season average price for this coming marketing year, and that would be 122. So that would start September 1 of this year and go till August 31st of next year. So they're projecting almost 550 prices. And looking at production of just under 15 billion bushels, up from about 14.2 last year. That number, we have USDA reports coming up. That number could go either direction. I would not be surprised, given some of the disease issues that we're hearing of people in some of the prime corn areas, that maybe that comes down 100 million, 200 million bushels, still a lot of corn. Ending stocks, 1.4 billion. We were at 1.2 billion last year. If this comes down 100, 200 million bushels, it probably comes right off of this. So we're down to 1.2. We'd be down to about where we were last year. Stocks to use, projected at 9.5%. So take ending stocks divided by total use, 9.5%. We were at 8% last year. If we take those 100 or 200 million bushels off of there, use about the same amount, then you're basically back there again. And here's the issue, that behavioral psychology things coming into agriculture. So we see 5.45 now, and we've seen great cash prices throughout the summer. Yet the last 2 years ago, we were at 3.56. This last year, 4.45, but through the fall at harvest, we were basically 3.60, 3.70. And then all that came in January. It came later. So really a big difference between this year and last year is that the first few months of this year were low, but once it got up there, and a lot of sales were done at that time, but then ended up averaging about this. So this year we're anticipating a front loading of better prices. So as of yesterday's close, we were at 532 for the lead corn futures contract, and as I think it's up. The Dees contract was up about 6 cents today, wasn't it? Is that about right? Dees corn up about 6. So I was talking with the gentleman in the back, and we were kind of thinking about how 1 or 2 cents in about 20 years ago would move the market. Now we get 6 cents. We're kind of deadened to volatility, but also the prices are higher as a percentage. 4 cents at 250, and now we have 6 cents at 5. If anything, we're equal or maybe not as much. So, but if we're just coming into harvest, at least from Dees corn's point of view, this recent low of just under $5 is probably something to watch. If we get some combination of factors that turn people really pessimistic in the market, short run, here you got just under $5, about 5.10 or so. You're kind of straining the gnat to get these lows here, but we haven't. And you can ask, well, what difference does that make as the market moves around? Well, it makes a difference because of the psychology where traders know we've been in the past. It's a psychology thing. And the normal seasonal pattern for corn, that's this purplish gradient line. This at harvest, September, October, actually tended to have lows in September, a little bit higher in October, November, and then reward storage a little bit going into November, December, January, February, March, April, May, on average, top out in June. And then with great crops coming on in most years, we start not to worry about things and we start to move lower. Well, we've had, last year, we started lower than normal in hindsight, ended up and had this big run in January, February, March, April, May, and then went sideways. This and averaged 466 as an average, season average price. This year projected, this is based off futures with I hope reasonable basis estimates, basically carrying current basis forward off futures contracts. In essence, looking at Dees corn and saying, well, we'll adjust a few cents off of Dees corn either way on a day, and we'll basically we pay attention to the upfront contract and make marginal adjustments thereafter. So if this holds true, then you'd have about a 514 per bushel price. Now the USDA projected that for this coming year at 545. So this conservative futures-based approach is still over $5, but not as the USDA is basically planning on basis narrowing up after harvest. Want to look at basis levels for Salina corn. You've got basis just under even. This is zero basis, and this would be positive basis, so just slight negative basis. Still the best, the tightest basis we've seen since 2017, just happening. Corn acres, likely that corn acres probably going to increase. So again, you've got this battle of inputs. What we desire to do is just what we can do. Will be more of a question this year with the inputs. There is this, you can see on a weekly basis, people arguing back and forth, analysts, as to what our average yield will be. And 176.3 is the USDA's latest number. If it came down to 174, 175, it'd be about where it's been in some of these other years without much problem. Still high levels. Corn production and supplies. This is billions of bushels. You can see 2 years ago, 13.6, 14 billion bushels, 14.2 last year, now basically 15 billion. With all of that happening, and then you've got supplies also slightly trending up. So no big moonshot in terms of extra supplies coming. Ethanol, just to show you this quickly, without digesting all those numbers, basically we're moving sideways for ethanol production. Corn use, ups and downs. This was COVID-19 hit. This was the freeze that happened last year when plants shut down. So story here is that ethanol production seems to be holding up decently. Higher fuel prices don't hurt that. And corn exports, part of the, well, here you'd seen in the red, the 2020-21 numbers started out kind of in the ballpark, but then with the South American problems, emerged to have the best year of corn exports we ever had. And this year we started out low. So to ask you a question, so on the one hand, we haven't got the crop out of the field yet, but what else has happened that would slow down corn exports slow down grain exports in the U.S.? What? Yes, and that would come from Hurricane Ida. It tore up a lot of ports, really slowed things down. So we haven't really seen export shipments take off yet. Purchases are good, but so we're hoping to borrow from the livestock industry and have some compensatory gain in the coming weeks. Here's the second thing to watch in the markets. This is my second major point. Would be that when you look at how many of last year's exports with the high prices we have were dependent on China, it's astounding. And I would say on the backside of that, if the United States got into a conflict somewhere in the Southeast Asian theater, and when you see that China's buying here 48% of corn, 60-some% of soybeans, about 10-15% of wheat, about 99% of grain sorghum. If the United States and China got crossways with one another again, and the day that happened, it would on the polite way to say it, it would be a strong negative for the markets. We'd probably lose 50 cents to $1. You know, you'd hit limit down if you really could not ship anymore. So this is a big thing. And so it's geopolitical risk in these markets. I'm not just, and when we make these projections, we are not factoring that in at all. But for your people that are looking at pricing grain and planning on high prices stay around, it'd be a bad combination. They have high input costs, and then some type of a conflict between US and China out into 2022, and prices drop. So I'm not saying we need to go forward contract everything we have, but boy, it's a time to be wary. I really think it's a time to be wary, because that geopolitical risk has not lessened. Here of late with what's happening in Afghanistan and where we're at now, the world's a more skittish, worried place than it was. And that's probably enough to say about that. So U.S. corn ending stocks to use, had been plugging right along about 2.2 billion bushels. Dropped this last year to this. Uncertain about this, but you can see stocks have gone down, stocks to use plunged. And what you'll see, you see this chart, you just change the name on the bottom, and a little bit of the scale. It's the same chart for corn, for soybeans, for wheat. And so stocks use going down, prices have gone up. About a two or 3 year situation. We did add in, if you look on your chart, you can see some details. There's some alternative scenarios of basically shorter crops or stronger exports versus a little higher crop scenario. It seems that unless we get some big surprise, you know, USDA is projecting 545, 510 to just under 6. It seems that we're destined to have that type of a year. I would say for the world corn supply demand, and which is a good thing for the people you loan money to, and really for our agribusinesses. Strong growth in usage of corn since 2007 through this last year. This last year is counting on a large South American crop recovery. So that what happened this year for sideways production ends up and moves to the higher side. Exports been strong, stocks been moving up, but when you have this much strength in usage, these hiccups and stumblings on production, you put them together and we're eroding stocks. So not just, I don't want to be over dramatic, but this is an important issue. In world grains, we've put everything together in aggregate. We've been sideways to lower on ending stocks. We've been tightening up. So $5.45 corn, nobody blinks at it. And I want to show this chart. If you take a world minus China stocks view of stocks to use, take the US price, adjust it for the US dollar. So you can see we've been moving from here up into these areas. This was a drought of 2012-13. Basically, we're just about there. So these are extraordinary. This is an extraordinary year. We thought 12-13 was extraordinary. So, you know, that's basically where we're at. Grain sorghum, strong exports at 585 US farm price. The corn price is 545. Production up from last year. Ending stocks, you know, 32 million bushels is not a billion there, it's millions. Strong exports, ethanol feed use generally lower. Stocks use pretty tight, 7.4%. But the price, 585, projected for this coming year, 345 to 5. 50 minutes, thank you. The last 2 years. And basis, 2020, strong growth really improving grain sorghum basis through the 2020 marketing year through October, November, December. That held strong through January, February, early March, fell off, is now recovered some. So the hopes of exports that we had to China coming in were so-so in terms of being fulfilled. We're just going to move through some of these. Grain sorghum acres have increased, probably likely to increase again next year. We did increase the size of the crop, 467 million bushels. 454 million bushels. Supplies had been right at 400. Jump that up a little bit. Exports through a tortured road. This blue line, you can see that the grain sorghum exports pretty strong, but inconsistent. Some good weeks, some not so good. And really, Hurricane Ida, haven't got the crop out of the field yet, affected us here so far. And see, for grain sorghum, we are an export dependent element right now. Got to have exports. The strength of China in this, you remember when the last presidential administration, when the US and China got squabbling over trade issues, what was the first ag commodity that the Chinese deliberately targeted? It was grain sorghum, because they could hit it, because it was there. I probably have 4 Kansas grain sorghum commissioners sitting in the room. I'm probably going to get chastised over later, but 99% of our exports go to China for grain sorghum. And this is what's projected. Now, this was in the last market. And again, you look at overall U.S. sorghum ending stocks to use and average prices. I have through feed grain numbers in there too. Generally, again, declining stocks, increased prices. And just see here, sorghum price, if world coarse grain, take out China, just the U.S. price for currency, and you know we're right on track in terms of where we expect prices to be. So we got just about 10 minutes, so I'm going to move pretty quick through these latter parts. For wheat, tight stocks, 660 per bushel, a little lower production this year, mainly because of spring wheat problems. Ending stocks, we have a 6 in front of that number. We get below 600 million bushels. On a food grain, you're getting pretty worrisome. We were at 844 million last year. Stocks to use dropped 10% in 1 year, from 40 to basically 30. Farm price, 660. So now this is how we see wheat, 660. The last 2 years we saw it as 5. Basically, it's $5. So what's happened in the world has an effect, well, 4.5 to 5 the last couple of years. We've benefited, even though we've had stronger hard red winter wheat production. We had the crop this year. Our cousins to the north for spring wheat in the U.S. and Canada didn't. White wheat was damaged also. So we increased supplies, have higher prices. Stocks to use for hard red winter wheat were about 56% last year. Now they're down to 40. So you're lending money into industries that for 2 years in a row have been tightening up for supplies. That's where we're at. And 705, and this is now up 9 cents as of from yesterday. We're really not worried about the downside at this point, but when we have moved lower, we got down to 560, 570, but heavens, we're at $7 now. Basis, okay, not tremendous, okay in Salina, about where we've been at this time of year in the past. Probably see some U.S. wheat planted acreage up. Total supplies, again, production generally declining, supplies declining as well. Exports, okay, on pace. Here you see Mexico being our biggest buyer, China about 10% last year. A lot of other years prior to that, they're about 2 or 3%. They entered even on wheat. Wheat ending stocks to use, again, stocks declining, stocks to use 55% high, now down to about 30. And again, here's that same chart again. Last 2 years, declining stocks to use, prices running higher. It's the same chart. It's affecting all these commodities that you're lending money into the production of. And it basically, if you change things by 50 million bushels, exports one way or the other, things are tight enough on the cusp. It makes a difference by my calculations of about instead of 660, 745. If you have 50 million bushels more, take 50 million bushels away, about 610. So a lot depends on exports. 10 minutes, thank you. Total usage, again, this chart also looks the same. Strong usage of wheat in the world, production, generally pretty good. Exports move to the higher side. You have ending stocks. Between these two, as they battle it out, you've got a strong trend to the higher side and then pretty much sideways on wheat. So strong usage, level stocks, production, sometimes good, sometimes not. You're tightening things up. You've got $7 wheat futures for hard red. And just to show you, again, another one of these charts, world less China, wheat adjusted price. By the time you take the currencies into account, we're just right there. In fact, we're even tighter than they were in 2012-13. So it's that type of extraordinary wheat year. And finish up on soybeans. Soybean stocks use tight stocks, 1290. And production, about 4.3, 4.4 billion, up from about 4.1 last year. Ending stocks, 185 million, just a little bit up from last year. This still to be finalized and determined. Stocks to use about 4.2%, 3.9. This is basically getting the brooms out and sweeping the edges of the bins. You know, it's just something of what you can find, because anything we've got, the world gobbles it up. And so here we're sitting at 1290 compared to the last 2 years. We were 857 2 years ago, 1090 last year. And we look at 1290 and say, oh, shucks, it's not 14. You know, so in terms of our frame of reference, our frame of reference basically was what we had. Next, our frame of reference is $16 to $17. For the last several years, we've been down in here. So with that, what does that psychology do to people? It tends to make them hold longer to sell than they should, because they remember what they just saw rather than what the last 2 years gave them. So that's how human psychology comes into marketing. 1277 up 9 cents now. We're at about 86. And if we were to move to the lower side again, it hasn't been lower when we get into the depth of harvest than 1240 for that contract. You want to watch that. This is the same basically chart, same pattern of chart we'd seen for corn. Projected, interesting, the futures project about 1291, the USDA projects 1290. So once in a while it comes together. Salina basis really hopping around, probably depending on whether we're exporting something or not. Pretty consistent in these years. Now it's the basis is volatile, but even with all that coming into harvest, it's the best basis we've seen since 2017 and including. Probably with good prices, see soybeans move to the higher side. If we have trouble getting inputs for corn, it might be even higher. Soybean production, again, supplies generally sideways, production moving a little bit higher. Soybean exports, you can see the part of the year when the United States was in the lead. You can see the part of the year when Brazil was in the lead. Our front loaded half to about the middle of the year, and then we slowed down considerably while the South American harvest came in. So, and now we're waiting to get our crop out of the field and getting the Hurricane Ida damage cleaned up. Again, if the U.S. gets sideways with China, there's conflict. Last year, China bought almost 60% of the U.S. soybeans. If that comes in, then has dramatic negative impact on U.S. grain markets. Soybeans probably the most. There's that chart again, declining stocks, increasing prices. It's the same chart. It's the same trend on each one of these. And in terms of where we're going, I tend to think that the production number is probably high and that the 1290 is on the low side of where we could go. Here's another chart, looks the same in terms of world soybean usage, strong growth. Again, this is for next marketing year, next year's South American harvest. Production as well showing up, strong usage. Get 5 minutes, 5 minutes. And pretty strong, an increase in stocks until recently, and now sideways, really sideways, a little bit lower. Our main competitor, what are they doing? They are increasing their production. And when you hear, it's not just hyperbole to say that there's more land that they could break out, and we really don't know how much they could produce. You don't see a lot of that in their eastern areas, but it sounds like they could go that direction too. So it is as it is, and so their exports matching the trend of their production. Their domestic crush pretty much sideways. Here in the U.S., I haven't mentioned it. If we see renewable soy diesel come in a big way, it seems that we're aiming at that. Then it's not inconceivable to see the soybean market become more domestically focused, just like the corn market became domestically focused on ethanol. Argentina, just for comparison, Argentina grows a lot of soybeans, but if anything, they're declining for soybeans. And they have drought issues that come in. And here's China, the big player in the soybean world. Strong growth in domestic crush with a blip, and then continued growth. Imports also coming on, that blip, and then back in there. And the thing about China is that their growth is slowing down. The rest of the world, every place else is also growing in soybean production. Just would mention cotton. Cotton's has an 84-cent price this year. It was 60 and 66 the last 2 years, but a lot of that's, it's not because of changes really domestically, it's an international thing. So I guess to summarize real quick, I probably have 2 minutes, right? Okay, 2 minutes. I would, the high prices now are going to elicit a response, but you won't probably see the downside of that response, all else being equal, until you get into next fall and get large crops. And input costs are probably going to influence what crops we can plant to the degree we want to plant them this year, and that could really surprise corn, I would think, maybe cotton. And then finally, we'll not pay any attention to geopolitical risk until it hits us. But if it does, then there's potential for some really negative impacts on U.S. markets that are so driven, we've just seen. Any questions?